everyone, welcome to Professor FinTech. Here is a question that stumps most people when they first start learning about accounting. If you do $10,000 worth of work in January but the client doesn't pay you until March, when did you actually make that money? January when you did the work, or March when you saw the money in your account? The answer to that one question is at the heart of one of the most important concepts in all of accounting. And by the end of this video, not only will you know the answer, you will understand exactly why it matters and how billion-dollar companies use it every single day. Welcome. Let's talk about accrual accounting. All right, let's make this real. Imagine you run a small freelance business. Maybe you are a designer, a consultant, writer, it doesn't matter. It's January, you land a big client, you spend the entire month working on a massive project. January 1st, you start the work, you are in the zone, putting in the hours, doing your best. End of January, you deliver the finished product and send over an invoice for $8,000. Nice, but the client has 30-day payment term, so the money it arrives in February. Now, here's the question, and really think about this. Look at your books for January under a simple system where you only count actual cash coming in and going out. Your January profit shows at zero. But wait, you work all of January. You earn 8,000 worth of value. You delivered the work. You did everything right, and yet your book says January was a zero income month. That feels wrong, doesn't it? That's exactly the problem that accrual accounting was designed to solve. Before we dive into accrual, let's first understand what most beginners start with: cash basis accounting. Cash basis is exactly what it sounds like. You record money when it physically moves. Money comes in, you record income. Money goes out, you record an expense. That's it, simple. Now, for a tiny business, a lemonade stand, a one person side hustle, cash basis can work fine. It's simple, it's easy to track, but here's the fatal flaw. Cash basis can completely distort the picture of how your business is actually performing. Like we just saw, you work all January, get paid in February, and your January books show zero income. That's not accurate. That's misleading. Now flip to the right side of your screen. Accrual basis. Accrual basis says record income when you earn it. Record expenses when you owe them, regardless of when the cash actually moves. So that $8,000 you earn in January under accrual, it goes on the books in January where it belongs. That's the core difference, and that's why most businesses and all publicly traded companies are required to use the accrual method. Let's get official for just 1 second. The formal definition of accrual concept is this: record revenues when they are earned and expenses when they are incurred, regardless of when cash is exchanged. Read that again. Two keywords jump out: earned and incurred. Earn means you delivered something of value, you completed the service, you sold the product. The transaction is done, even if no money has changed the hands. Incurred means you received a benefit or created an obligation. You got the supplies, you used the electricity. The cost is real. Even if you haven't paid the bill yet, four pillars hold this whole concept up. First, timing. Which time period did this actually happen in? Second, earning. When was revenue actually generated? Third, incurring. When was the expense actually created? And the fourth, compliance. This is the gold standard required by GAAP and IFRS, the two main accounting frameworks used around the world. All right, let's cement this with a story, and I want you to really visualize this one. You own a coffee shop, it's great little spot, good vibes, good bills, loyal customers. On January 1st, your coffee roaster delivers a huge order of beans, $5,000 worth. You shake hands, sign the delivery note, and get to brewing. But here's the thing: you have a credit arrangement with the roaster. Payment isn't due until February 15th. So let's talk the timeline together. Follow along on the screen. January 1st, beans arrive. They are sitting in your stock room. You are using them to make coffee, make your revenue, run your business. The cost has been incurred. The beans are benefiting you right now. January 31st, the month closes. Your accountant needs to finalize the books. February 15th, you actually write the check. Cash leaves your bank. Now here's the key question. Under cash basis, when is the 5,000 expenses recorded? February 15th, because that's when the money moved. But under accrual, January 1st, because that's when received and started using the beans. That's when the cost was incurred. See the difference. Under cash basis, your January books look $5,000 cheaper than reality. Your profits look inflated. It's false picture. Accrual gives you the truth. Now I want to introduce you to the secret weapon behind accrual accounting, something called matching principle. The matching principle is simple but powerful. Expenses should be recorded in the same period as the revenue they help generate. Revenue matched with the expense that created it in the same time period every time. Let me show you why such a big deal. Let's say you are a building contractor. In month one, you power the foundation. You bill $50,000. You spend $30,000 on materials. Under accrual and matching, both go in month one. Your month one profit is 20,000. Accurate. Month two, you build the walls, bill $80,000, spend $45,000. Again, both matched. Month two profit is $35,000. Month three, finishing touches, $70,000 revenue, $25,000 cost. Month three profit is 45,000. Now imagine you try to use cash basis. Maybe you got paid for month one, two, three, all in one big lump sum at the end, and you bought all your materials upfront in the month one. Your books would show month one as a massive loss and the final month as a pure profit. Neither is accurate. It's financial noise. Matching cuts through the noise. It shows you the real profit for each real period. Okay, let's get practical. How do you actually record an accrual in your accounting system? We are going back to the coffee shop example. $5,000 beans received January 1st, paid February 15th. Step 1. January 1st, the beans arrive. Even though no money has arrived, you record two things. First, you debit supplies expenses for $5,000. A debit to an expense account means the expenses is going up because you just use the 5,000 of a value. Second, you credit accounts payable for $5,000. A credit to a liability means the liability is going up because you now owe $5,000 to the roaster. Notice what just happened. The expenses is recorded, the liability is recorded, but not a single dollar has left your bank yet. That's the beauty of accrual. Step 2, February 15th, you pay the bill. Now you record the cash movement. Debit, accounts payable $5,000. This wipes out the liability. Debit gone. Credit cash $5,000. Money leaves your bank clean. Two entries: first record the economic event, second records the cash flow. Together they tell the complete accurate story. If you now see here, accounts payable in a first table in the month of January, accounts payable $5,000 was showing in the credit side, and the second table on a February, accounts payable showing on a $5,000 at a debit side. These two gets nullified. So final entry that we will remain in the system is supplies account $5,000 debit, cash or bank account 5,000 credit in the month of February. So January supplies and cash went in the month of February. So this will be the remain. Hope you understand here. Now there are actually 4 different types of accrual adjustment you need to know. Let me walk you through each one. They all follow the same core logic. Type 1, accrued revenue. This is where you have earned money but haven't received yet. Like our original freelancer example, we work done in March, paid in April. You record March revenue. In March. Simple. Type 2, accrued expenses. This is where you have owned money but haven't paid yet. Like our coffee bean story. Beans received in January, paid in February. Record January expenses in January. Type 3, deferred revenue. This one's a bit counterintuitive. A client pays you $12,000 upfront for 12 months of a service. Even though the cash is sitting in your account, you haven't earned it yet. So you record 1,000 per month as you deliver the service because that's when you earn it. Type 4, prepaid expenses. You paid $6,000 for annual insurance upfront in January, but the insurance benefit covers 12 months. So instead of recording a $6,000 expense in January, you record $500 per month, spreading the cost across the period it actually covers. All, all 4 follow the same principle. Record the economic reality in the period where it actually belongs. Let me show you something visually that really drives this this home. Take a consultant who earns $5,000 per month for 3 months. January, February, March, always the same amount, always delivered on time. But let's say all the clients pay in February. All 3 months worth of invoices paid at once. Look at the cash basis bars on a screen. January, zero. February, $15,000, March, zero. If you were an investor looking at those numbers, what would you think? You would think February was a great month and the other two were disasters. You might panic, you might make bad decisions. Now look at the accrual bars. January 5,000, February $5,000, March $5,000. A perfectly smooth, consistent, accurate story. The business earned the same amount each month, and that's exactly what the books show. This is why investors, banks, auditors require accrual accounting because it gives a true picture, not distorted one, based on when clients happen to send wire transfer. All right, here's your moment of truth. Quick quiz. Pause the video if you want to think about it. You complete $8,000 of web design work in March. The client pays you in April under accrual accounting. When do you record the revenue? Option 1, April, when the money arrives. Option B, March, when you did the work. Option C, split between March and April. Option D, whenever it's most convenient for taxes. Answer is B, March. Why? Because that's when you earn it. The work was done in March, the value was delivered in March, the revenue belongs in the March, full stop. It doesn't matter that the client is slow to pay. Under accrual, the economic event, not the cash event, is what drives the recording. If you got that right, excellent. If not, go back to the beginning and read them again. It will click. So who actually has to use accrual accounting, and can you still use the cash basis? Cash basis is still perfectly legal and usable, but mainly for very small businesses. In the United States, for example, if your average annual revenue is under $25 million, you generally have the option to use cash basis. Same story in many other countries. There are thresholds. But if you are over those thresholds, you are legally required to use accrual. And if you are a publicly traded company, it's accrual full stop, no exception. GAAP requires it in the US, IFRS requires it globally. Here's the bottom line on when to use each one. Cash basis, you are a sole trader, freelancer, or tiny business. Few transactions, simple life, cash basis is fine. Accrual basis, you have employees, inventory, credit arrangements, investors, or you are planning to grow. Accrual is the only way to use what's actually going on. The bigger and more complex your business, the more you need accrual, because without it, the pictures get dangerously distorted. All right, let's bring it all together. 5 key takeaways you should be walking away with. Number 1, accrual means record when earned or incurred, not when cash moves. That's the foundation. Everything else builds on that. Number 2, the matching principle. Every expense should be recorded in the same period as the revenue. It helps create revenue and cost. Match together period by period. Number 3, there are 4 types of accrual entries: accrued revenue, accrued expense, deferred revenue, prepaid expense. Each handles a slightly different timing scenario, but all follow the same core logic. Number 4, most medium and large businesses are legally required to use accrual. If you work in accounting, finance, or business, this isn't optional knowledge, it's essential. Number 5, accrual gives you the truth. It shows the real financial performance of a business in real time, no distorted by whether client pay early or late. And that's it. You now understand accrual accounting. Seriously, think about how far you have come in the last 10 minutes. You now understand a concept that confuses many first year accounting students. You know why the world's biggest companies, Amazon, Apple, Google, record a sale the moment they deliver a product, not when the check clears. You understand why financial statements show a true picture of economic reality, not just a cash log. That's genuinely useful knowledge. If this video helps you, drop a like. It genuinely helps this channel reach more people who are trying to learn this stuff from scratch. If you are new here, subscribe. We break down accounting, finance, and business concept exactly like this. Plain English, real examples, no jargon for the sake of a jargon. and leave me a comment. I want to know what topic should we cover next. Depreciation, financial statement, the accounting equation. Let me know below. Coming up next, we are diving into adjusting entries, bad debt expenses, and depreciation. Three more concepts that use everything you just learned today. I will see you in the next one. Thanks for watching.